Goldman Sachs. For decades, it's been the vampire squid of Wall Street, powerful, mysterious, and always where the money is. But looking at their 2025 numbers, I realized something. The squid is trying to turn into a high-end concierge. Today, we're going beyond the balance sheet to see if this pivot is a masterstroke or a desperate retreat from a crater-sized hole in the regulatory landscape. Here's the hook. Goldman is currently playing a high-stakes game of trading spaces. They're trading their volatile, heart-attack-inducing trading profits for boring, stable management fees. Why? Because the regulators, the financial police, are coming with a new set of rules called the Endgame. And these rules might just make their traditional way of making money illegal, or at least incredibly expensive. Let's look at the bread and butter. 2025 was a monster year. $58 billion in revenue. To put that in perspective, that's enough to buy a Tesla for every single person living in New York City and still have change for lunch. Their ROE, basically the report card of how well they use your money, hit 15%. They are officially back in the A student category. But here's the twist. Goldman is breaking up with you. Well, unless you're a billionaire. They've sold off the GM card and they're moving away from the Apple card. Why? Because mass market banking is like running a discount supermarket. High volume, low margins, lots of headaches. They're pivoting to UHNW, ultra high net worth. Think of it as closing the Walmart branch to open a private boutique for the 0.01%. Look at this donut. 71% of the money still comes from the global banking and markets, the high-octane trading and deal-making. It's the engine of the Ferrari. But as powerful as it is, engines are noisy and consume a lot of gas. Goldman wants that other slice, asset management, to grow, because that's the electric motor that runs quietly and keeps the car moving even when the gas runs out. Speaking of that motor, they just hit $3.6 trillion in assets. If those dollars were seconds, we'd be talking about 114,000 years. This is their safe haven. These are fees they get just for showing up and managing money. It's the ultimate capital-light business. No more betting the house, just collecting a small slice of everyone else's house. Now, are they running a tight ship? Their efficiency ratio is 64%. In simple terms, for every dollar they earn, they spend 64 cents on, quote, keeping the lights on and paying their star traders. It's getting a bit more expensive to run this club. Why? Because finding the best talent in the world isn't cheap, and neither is the technology needed to stay ahead of the AI curve. Now, here's the scary part. The capital trap. Even though they're swimming in cash, the financial police are raising the GSIB surcharge to 3.5%. It's like a luxury tax for being too big. This could freeze their plan to buy back $32 billion of their own shares. Imagine having a vault full of gold, but the government tells you that you're not allowed to touch it because you might need it for a rainy century. So where is the growth? Private credit. They want to manage $300 billion in credit by 2028. They're moving from lending their own money to lending other people's money. It's the difference between being the guy who bets on the race and being the guy who owns the track. You always want to own the track. Check out this timeline. We're in a 4-year sprint to 2028. Every year, the rules get tighter. Goldman has to be more efficient, more asset-light, and more global. If they don't hit these milestones, they'll be forced to hold so much capital, they'll basically become a very expensive piggy bank. But what if the world breaks? Goldman isn't blind. They've modeled a hard landing, 7.4% unemployment. That's a lot of people out of work, and a lot of businesses failing. If that happens, even the smartest guys in the room at 200 West Street are going to feel the heat. Their models are good, but as we saw in August 2024, the market can sometimes lose its mind faster than a model can react. And then there's the world map. Trade wars, tariffs, and the delicate balance in the Taiwan-China Strait. Goldman's moat isn't just money, it's intel. They have eyes in 50 countries. They have to navigate these trade fractures like a world-class chess player, because one wrong move in a regional conflict could wipe out a decade of deal-making. To keep costs down, they're moving the engine room to places like Bengaluru and Warsaw. Almost half of their team is now in these strategic hubs. It's about engineering excellence. They're also building a wall of AI governance to make sure the robots don't accidentally trade away the firm's reputation. The final verdict? They're raising their dividend to $4.50. That's a massive vote of confidence. It's Goldman telling the world, we see the risks, we see the regulations, but we're still making enough cash to pay our shareholders handsomely. It's a flex, pure and simple. So is the transformation working? The 1GS strategy is the only way to survive. They're shedding the weight of mass market banking to become a lean, mean, fee-generating machine for the global elite. If they pull this off, they won't just be a bank, they'll be the operating system for the world's wealth. If you want the full, unfiltered page report on this transformation, you know where to find us. Drop us an email at sales@hdinresearch.com or visit our site. Don't forget to like, subscribe, and tell us in the comments, do you trust the new Goldman? I'm from HDIN Research, and I'll see you in the next deep dive.